Welcome to Wall Street Training's module on the overview of the financial markets. In this module, we will quickly go through the specific industry jargon and go through exactly what is the sell side, the buy side, what is exactly investment banking, asset management, sales and trading, as well as hedge funds and alternatives. Let's take a quick look at hedge funds. Hedge funds these days are extremely popular. What's a hedge fund? Let's think about what the word hedge means. Hedge means a means of protection or defense. It's a transaction that reduces your risk. The funny thing is, a hedge fund is the exact opposite. Traditionally, a hedge fund uses a hedging strategy, again, to hedge away any risk by attempting to offset the price fluctuations and neutralize market variations. The mainstream definition these days of what a hedge fund is, a private investment company, it's kind of similar to a private equity fund, but they use high-risk techniques actually to make extraordinary proprietary excess profits. So, in fact, instead of trying to hedge away risk, they're actually actively looking for additional risk. Not that they're looking for additional risk, but they're trying to actively manage and actively try to seek out arbitrage opportunities. There's a wealth of information on the internet on the different hedge fund strategies, but a quick list of them are here. You have your long-short equity, in which you try to arbitrage what you believe might be a long strategy, which means buy, and a short strategy, which means sell. Absolute return basically says, I will try to always aim for, let's say, a 10% minimum return, regardless of what happens to the macroeconomic factors as well as what happens in the broader market. Event-driven. Event-driven strategies basically say, I'm driven by a particular event, whether it's an earnings announcement or whatnot. Merger arbitrage looks specifically at M&A transactions that have been announced but not yet closed, and they try to arbitrage the difference in pricing movements of the target and the acquirer. Convertible arbitrage is another pretty unique strategy in which they try to arbitrage the difference between a convertible bond and what that convertible bond can come in stock. And they might either, let's say, buy the bond by shorting the stock, etc., to make that arbitrage work so that regardless of what happens to stock price, they will still earn money. Distressed securities are securities that are simply distressed. This is probably a little bit more of a longer-term strategy traditionally and may be more akin to a private equity strategy. Global macro takes a look at the global macroeconomic factors based on GDP growth, interest rates, etc., to try to figure out, and inflation as well, to try to figure out what might happen in the global economy and then to try to capitalize on those trends. Emerging markets might be considered another hedge fund strategy as well, in which they try to invest specifically in emerging markets. Multi-strategy simply means a fund that has one or more than one or all of these strategies, in which you can cherry pick this current strategy that is hot and start doing with the ones that are not. So again, you have additional diversification even within that particular hedge fund. Now, let's look at the characteristics of a hedge fund. First of all, because a lot of capital is offshore for tax purposes, you might have an offshore versus an onshore entity. Hedge funds, similar to private equity funds, also have a high minimum investment. Liquidity, there are typically lockup periods and periodic redemptions. In other words, I can't just say, oh, give me my money back tomorrow. Why not? Because they might take some time to unwind those investments. Hedge funds are typically shorter term in nature. They try to get quick, short, excess returns as opposed to a longer duration of private equity in which you actually need the company to build itself up and whatnot. There's, traditionally speaking, a lack of transparency because people and the hedge fund managers do not want to reveal their strategies because they might be afraid that other people will try to poach and try to replicate those strategies. Hedge funds are very, very, very performance-based. In other words, they might typically have a 110 or 220 structure. In other words, what that means is they will charge anywhere between 1 to 2% of the assets under management and what we call the carried interest of 10 to 20% of profits. So again, they can make a fair amount of money. Hedge fund of funds are similar to private equity fund of funds. These hedge fund of funds invest in other hedge funds. And again, similar to our previous discussion on private equity fund of funds, they allow access to multiple hedge fund managers simultaneously, allocate funds as appropriate, less capital required than investing with separate managers, so not unsimilar to what we talked about before. Let's take a look at the hedge fund professionals and the hierarchy. On the top, you might have your hedge fund manager. This hedge fund manager oversees the entire hedge fund operations and makes trading decisions not unsimilar to a portfolio manager. Smaller hedge funds will actually see this hedge fund manager as well as the portfolio manager as the exact same person. They may also manage the human resources and additional risk management. The portfolio manager, again, sometimes maybe the same person as a hedge fund manager, but they are the ones who execute the hedge fund strategy. They do the research, the stock picking, the security selection, and also their job is to actually implement the specific investment strategy. Similar to what we talked about on the buy side and the sell side, supporting the portfolio manager is the research. They still need research and a basis to now evaluate the investments and the stocks that they may decide to buy or to sell. And again, these research guys, they will assist the portfolio managers and the traders with financial modeling as well as additional statistics. The traders are the ones who actually physically execute the trades, the buying and selling of securities. And again, these are the ones who may have the relationship with the Wall Street brokers and the prime brokers, which again, prime brokerage are firms that provide brokerage services to other institutions. Many times on a smaller hedge fund, you might see that the trader, the portfolio manager, and the hedge fund manager might even be the same person. In an ideal world, you have separation of duty if you have a large enough fund so that you can make sure that you can properly allocate and specialize in what you are good at. Overseeing all of this is the risk management. The risk management will actively monitor and try to reduce or remove all the risk. They will do a lot of back testing, stress testing, VAR, value at risk analysis to try to minimize the fluctuations in terms of what their assets might do if there was an adverse event. Optimization of the portfolio as well as asset allocation of their positions. So again, the job of the risk manager is to make sure that these other folks on top are doing the job properly and they don't have too much of their money in one particular concentration. Other functions within a hedge fund are operations, accounting, as well as investor relations. Of course, that also includes your sales and marketing folks because you still need, at the end of the day, to raise capital. So this is a very quick hierarchy of the different hedge fund professionals. Let's now take a look at the same thing for our hedge fund professionals. Again, on the top side here, you have your portfolio manager who actually sets the investment guidelines and parameters. They are the ones who pick the funds. Remember, they are not stock pickers. They are not stock pickers. They are fund pickers. They also research the trends and the best practices. The risk management of a hedge fund is also very important. They need to make sure that all the different hedge funds they've invested in have not had too much correlation in the past or have not overinvested in one particular industry or sector that would now, if that particular industry or sector moves adversely, even though they had invested with several different hedge funds, they may end up actually being hit pretty hard because they invested in too much of a similar type of security. Same thing as before, asset allocation, optimization, and constant portfolio rebalancing to make sure indeed that they have mitigated and tried to avoid and reduce the risk. At the bottom is the due diligence analyst. The due diligence analyst is responsible for analyzing the underlying fund performance, the management team, etc., research and peer comparison. This due diligence analyst, again, is not looking at the stocks, is not building financial models of a particular security, but they are analyzing and evaluating that particular hedge fund that this hedge fund is about to invest in.